Good afternoon, good morning, depending on where you are in the country. Welcome to the I can't believe it's June strategy update already. My name is Keith Duran. I'm the Senior VP of Business Development. And as always, we're joined by Jim Warner, the Head of Research and Co-Portfolio Manager. These meetings, thank you for taking time out of your day. These meetings are really kind of twofold. They're meant to, provide sort of an economic background or backdrop, as well as to provide, information about our portfolios, right? So, in other words, what's happening in the market and these macroeconomic trends, and then how are we positioning our portfolio, given the information that we see. So before I start, I just want to say that we encourage everybody to ask questions. At the bottom of your screen, there's a Q&A button. Feel free to ask away during the presentation, and then we'll address those at the end of the meeting. So, Jim, if I haven't missed anything, I'll hand it over to you.
Great. All right. Thanks a lot, Keith. Thanks, everybody, for joining us today. So let me get my screen shared here. Okay. So the title of this month's webinar is "The Everything Rally is Set to Narrow." We're going to talk a little bit about what that means. But whenever we get these big pullbacks, what you tend to get is you get a big everything drives to like a one correlation on the drawdown, and then it remains fairly correlated on the bounce back. And if you remember, about a month ago, well, 2 months ago even, we wrote a newsletter, and hopefully you're also getting our newsletters. We try to space out this webinar and the newsletter so that they kind of play off of each other. But so talk to Keith or me about getting on that list if you're not. But we talked a lot about one of our biggest concerns about 6 weeks ago was making sure that we were prepared for a V-shaped recovery. And we did, and thankfully, because it turns out we've had a really big V-shaped recovery as the trade tensions have really sort of weakened, and we'll go into a little bit more about that. But the economies remain strong despite all the confusion over the tariffs. So we ended up having one of the best Mays ever in the market. The S&P was up 6.3%. The S&P is up just a titch for the year. The Nasdaq was up even more, and we'll talk about why. And it now is about flat, little less, little underwater for the year. So these are all numbers through the end of March. So really nice bounce back. We said a month ago that we thought that tech and the Mag 7 would outperform this past month, and they did. The Mag 7 has now bounced 30% from the bottoms of the market, which is a little bit more than a month ago. And the rest of the S&P 500 has bounced about 16%. Now, obviously, the Mag 7 went down more, but that's what happens. So usually what happens is when you get these, whenever you get these big 10+% pullbacks in the market, usually they're driven by some concern over the economy going into recession. And the things that tend to get hit the hardest are the ones that are the most over-owned. And that was certainly the Mag 7. And so you saw basically those names underperform the most. We highlighted last month that we thought that the relative valuations were much more attractive and they were better positioned to handle tariff issues. And I think the market eventually came around to what we were thinking. And so we've seen a nice bounce back in not just Mag 7, but other tech names that are in the kind of artificial intelligence theme that we love and the electrification theme that we love, kind of the big data center build out that's going on around not just this country, but the world. And one of the reasons why the Mag 7 is bouncing back relative to the rest of the S&P is because the earnings estimates are staying more robust than the rest of the S&P. And so you can see in this graph that from about a year ago, the 2026 consensus earnings estimates for the Mag 7 are up have increased about 21%. Meanwhile, they've shrank 5% for the rest of the S&P. So what you're seeing is a resiliency that is in the Mag 7 earnings estimates that you're not seeing in the more cyclical areas of the economy. And that actually makes sense, right? I mean, it makes sense that tariffs are going to impact more the trucking and apparel sectors as opposed to, Google or Meta, or Amazon or Nvidia, for that matter. So, and from our perspective, if these trends persist, which more or less we expect, then the Mag 7 and tech generally should continue to outperform in the near term. I think I mentioned this in my newsletter I sent out a couple weeks ago, but the easy money is over now. This broad rally with everything correlated near one is basically largely over. I think you're going to start to see much more divergence in terms of what works and what doesn't work. If we just want a simple way to summarize that is to look at the Mag 7 versus the rest of the S&P, what's happening with their PE multiples. The Mag 7s has bounced back, but it's still trading at a 6% discount to its 5-year average. Meanwhile, the rest of the S&P is trading at an 8% premium to its historical average, which is a little wild considering that these are the businesses that are more subject to tariffs and more subject to economic downturns. So, I think where we're putting where we're leaning more into is tech vis-a-vis other businesses. Not to suggest that there isn't value in the rest of the S&P, but just broadly speaking, I think you're going to see a divergence between those two groups. A lot of has been made recently about the taco trade. This stands for Trump always chickens out. Now that's, I think, a fairly mean way of putting it, but we wrote about this 2 months ago, right? In the art of the deal, what Trump does is he puts up a extraordinary or extreme position at the beginning of a negotiation, and then he pulls back from it. And I'm not sure that's chickening out. I think that's just moving towards a zone of agreement. But nevertheless, we've been basically buying these dips every time that the market freaks out about something extreme that President Trump proposes. And I just threw this chart up here of the S&P 500. You can see, the dramatic, Mexico-Canada tariffs. Those are ultimately pulled back. Liberation Day reciprocal tariffs, those are really extreme. They paused those a week later. Then there were the crazy high tariffs on China. That lasted about 8 days. The proposed 50% tariffs on the EU, that lasted all of about 3 days over a weekend. So there's this, he's obviously uses extreme language and extreme proposals to bring people to the negotiating table. And then using the pause to actually negotiate deals. So, I think as you can see, the market's getting a little bit, satiated by this. I mean, obviously, coming up even with the acronym taco trade means that we're getting now the market's getting accustomed to this pattern. We've had obviously during the last month, which has supported the rally in the markets, this idea of a thawing of the trade war, although I would argue it was never a war. Certainly, the trade rhetoric has de-escalated. In June, I think we're going to see some bilateral deals actually get done. There hasn't really been any. I don't know if, I guess you could count the UK one. But, in the offing are India, probably something to do with Mexico and Canada. Japan has been rumored. South Korea has been rumored. I think we're going to probably see movement after the G7 meeting, which is, going to be in about a week or two. Again, look, these bilateral trade deals are very hard to do. Oftentimes they take years, and so trying to jam them into like 2 or 3 months is a pretty high ask. We have no idea how many will get done by July 9th, but that's the theoretical endpoint of the pause. Of course, it could get extended. But it caused us, as we thought through all the relative uncertainties of tariffs, to just take a step back and say, okay, how much does this really matter to the economy? And the fact is that imported goods are just 14% of GDP. Okay, it's not 50, right? There's 86% of GDP that has nothing to do with imported goods. Now, there may be some indirect relationships, but what this basically means to us is, and our thesis has been over the last probably 6 weeks, that the overall this new trade dynamic that will be established whenever these deals are done will be manageable for the vast majority of the economy. Yes, there will be certain sectors that will be hit extremely hard, potentially, whether it's apparel or, trucking or, there could be some, fairly dramatic impacts on certain industries. But I think it's going to be relatively manageable. Of course, our head is up above water and we're, looking to see if we get any unwanted surprises. Certainly, July 9th could be, some interesting fireworks. But by and large, I think it's going to be pretty manageable. It is interesting to see that the tariffs are having a positive impact on revenues. Um, this chart is of the customs receipts. So this is the actual tariff revenues that are being received on imported goods. You can see that even with the pull forward that we saw last quarter in imports, there was still pretty decent acceleration and more than basically a doubling of revenue. Now this graph shows annualized tariff revenue, but this is it's starting to creep up in meaningful numbers. We have no idea of where this is going to actually settle out. I mean, recall where we were before all of this tariff stuff was the average tariff on an imported good was about 3%. The calculations we've seen is that the average tariff right now is about 17%. We're not sure where this ends up, but that gives you a little bit of an indication of what kind of revenue collection could occur. So all this while, the market, as it's been rebounding pretty dramatically, has been climbing what we always call the wall of worry. And there's really three specific worries that we'd point out. Obviously, we've talked a lot about tariffs, so we don't really know what the actual tariff impact is going to be. Our best guess is that the average tariff will settle out around 10%. Hard to say. There's obviously been some legal challenges recently, but I think we have to go with the assumption that these tariffs will not be challenged legally. There's plenty of other avenues that the administration has to put tariffs through, so I'm not sure that that's going to be successful. I think we have to assume kind of the worst case scenario. As I mentioned, it's going to be the outcome will be acute for certain industries, but not for all, and probably manageable. The next big thing is the big beautiful bill. As you all know, it has gotten through the House. It is now the Senate just got back they have kind of a quick, well, they'll be in session until July or later July, and then they go on recess. And we really don't think that the bill will get done before the August recess. There are a handful of Senate Republicans that do not like the deficits that are going to be created by this bill. The CBO actually this morning came out and said that they estimate that the deficits will be about $2.4 trillion. Now I'm not going to go into the details of how they calculate all that, and there's some issues that actually probably overstates the deficit a little bit, but the reality is it creates a deficit, and that's bothering certain Republicans. The most important thing, and I've talked about this before, is there's really two pieces to this bill that are relevant to us as investors. The first is extending the 2017 tax cuts. If that doesn't happen, this economy will fall into a pretty good size recession. Okay. Those have to get extended. The second piece to it is the additional tax cuts that Trump wants. And that's where this is kind of the no tax on tips, no tax on Social Security. Frankly, not a lot of seniors pay taxes anyway on Social Security, but it's a nice talking point. And then all the other tax breaks that will be out there for bringing, reshoring or onshoring manufacturing. There's some pretty aggressive things there. So, how this all comes out in the wash, nobody really knows. I mean, I think there's enough voices in the Senate where you may get a different looking bill, and then you're going to have to see the reconciliation process at work. So, we're not holding our breath on this passage, but it has to get done eventually, particularly with related to extending the 2017 tax cuts. Otherwise, we need to take a very different approach to risk. And then lastly, the deficit. So it's pretty clear that neither party nor the administration is taking any of it seriously. Maybe, just a handful of senators, and and now we know Elon Musk is taking it seriously, but it really should be taken seriously, and we take it seriously. I mean, at the current projections, we're going to spend nearly $1 trillion on interest expense, which is basically how much we spend on defense. And that's just you're seeing the crowding out effect of the deficit, and that's going to become an even bigger problem as we get really into the height of the deficit spending that will be required for the mandatory programs like Medicare, Medicaid, and Social Security in the coming years. So it's a problem, and it's actually one of the reasons why we continue to like to own gold, because ultimately these deficits should actually weaken the dollar. And we're actually starting to really like Bitcoin and add that to portfolios. And we can talk about that more extensively if you want in the Q&A. But the deficit's a real problem, and we're gonna have to keep an eye on it. So let's do a quick check on the economics, sort of the macro. One thing that's been obviously been pretty clear is that the soft data has been coming in way lighter than the hard data. Soft data is, of course, this various different surveys that are taken, and I put four up here. Like, for example, the University of Michigan's Consumer Sentiment Index has fallen on tough times. The trade uncertainty. These are all surveys. They basically ask people like, well, how do you feel about the economy, or how do you feel about inflation, or how do you feel about stocks? Investors are very bearish. And this is in contrast to what has actually been fairly solid economic data. So, and that's the hard data, the measurables. So let's talk about the measurables. The first let's take a look at is inflation. So, the core PCE just came in for April, it's 2.5%. We've talked ad nauseum over the last 2 years about how shelter is propping that up. And when you take out shelter, the chart on the right shows you that inflation's only at 2.2%, which is pretty darn close to the Fed's 2% target. And by the way, where is the surge? Inflation that everybody's worried about from tariffs. Now, I know that maybe it's still working through the inventories. Maybe, companies haven't changed their pricing yet, so maybe it's coming, but we haven't seen it yet. So, kind of this, we just had, there's been a big panic over this, and we're just not seeing it in the data as yet. The other thing that remains stable is the labor market. So there haven't been the mass layoffs that everyone was concerned about. The unemployment rates stayed at around a solid kind of low fours. Continuing claims aren't going crazy. We had a relatively weak ADP print this morning, which most people don't really take seriously. We'll see we have another payroll report this Friday. We'll just have to see where it goes. But we aren't seeing labor fall, the labor market fall off a cliff. And I think that's the most important thing because it's keeping spending up. So the consumers remain very resilient. Consumer spending is really the key to propelling economic growth, and we're just not seeing anything that smells like a recession. In fact, yesterday there was an important data point that came out on that consumers are starting, or homeowners are starting to tap their home equity lines. Now, there is apparently something like $2 trillion of equity that can get tapped. So to the extent that we start to see homeowners tap all this massive amounts of equity that's in their homes, that's another kind of source of funds to help keep spending solid and therefore the economy solid. So we'll see. I think the other data point I'm showing on this page that's interesting is personal savings has actually been increasing over the last few months, which is pretty wild. I mean, if things are so bad, why would we be seeing an increase in savings? Now, and again, these are big averages. And yes, there are pockets of society that are not, that are having difficult times. There's no question about that. But what's driving the overall economy, these particular metrics, is still hanging in there. The other interesting data point we'll get here in the next, probably 6 weeks is Q2 GDP. And if you'll recall, last month we talked about the 1Q GDP print, which was -0.3, and I said, don't worry about it. It was basically a function of a surge in imports of businesses importing their goods ahead of the tariffs hitting. And that, of course, in the GDP calculation creates a negative, drag on the print. We're actually going to see the exact opposite happen. And so the Atlanta GDP Fed Now forecast is for Q2 to come in at 3.8%. So that's a huge surge. If you see on the chart on the right, um, we've been around that before, but I think when you sort of back out what's really happening, because there's going to be a lot of noise in this print as well, the economy's probably growing in a kind of a 2 to 3% range. Consumption, the big components like consumption and inventories are hanging in there and growing nicely. So, again, no real clear warning signs as yet that the economy's falling apart. Nevertheless, after a big run up in the markets, it's important for investors to get a little bit more choosy, and I think they will. This is what I'm talking about the market getting more narrow and not everything working. Like, you could have closed your eyes and thrown a dart and just hit it, a dart at a page of stocks, and they probably all went up. Obviously, some more than most, but I think that's going to stop, or just in the near future. But where do we sit here today? Market and economy are showing resilience. We've got this trade situation with tariffs that I think we'll get more resolution to, and I think the ultimate answer is that it's going to be broadly manageable. We haven't seen an inflation surge, which, by the way, is really important, because if we do start to see weakness in the economy, the Fed needs to feel like inflation is tame enough that they can lower interest rates. And so, we're going to have to watch that metric very closely, but no surge just yet. And we are seeing, we just finished up kind of the Q1 earnings season, and we're kind of in the middle of conference season where you get, further updates from management teams on how things are going. And actually, there's quite a few companies that are getting their earnings revised upward. So it's not all bad for all the companies. And that just means that you're going to have to be selective. So the way we're being selective in choosing names for the portfolio is, we basically have kind of three requirements. One is they need to have bulletproof demand for their, product or service to sustain revenue growth. And number two, they need to have a predictable supply chain or cost structure so that you can be sure that the margins are going to hang in there. And then the third piece is that we have confidence in 2026 earnings. Remember, we're looking out a year. If they have some near-term missteps because of tariffs or what have you, or some other reason, that's fine. What we really care about is what does next year's earnings power look like? So we're being patient, we're being very disciplined, and we're finding some great opportunities. So let me touch quickly then on the portfolio itself and themes that we have in it. As you all know, we love themes. It's a great way of narrowing down the world and into important themes. So our sort of AI, technology, digitalization, cloud computing, whatever you want to call it, themes, cybersecurity. We just think that technology is still broadly under-owned by most managers. It was probably over-owned coming into this year, and then during the sell-off, there was a lot of panic selling, and a lot of hedge funds and long-only managers are now actually underweight technology. We think that this is going to give it some legs. It's got a better relative valuation and better fundamentals than a lot of the rest of the market. Kind of connected to the AI and data center build-out theme is our electrification theme, and that's rebounding nicely. The more work that we do on this and the more we play around with AI, and we see just how relevant AI is to just increasing the productivity in our own office. It is really mind-blowing. I mean, this is really, honestly, the most important technology of our lifetimes. And because we feel so strongly about that, you then do the math on the amount of electricity power generation that's going to be needed over the course of the next 5 to 10 years. And you're like, whoa, that is the big bottleneck, right? There's just not enough power gen going on in this country over the course of the next year. So there's going to be massive build out. And it's going to mean grids need to get bigger, more robust. It's going to hit, we're going to have more robust transformers. We're going to have to build, small modular reactors. We're going to have more natural gas. I mean, on and on and on. It's an incredibly important theme. The market kind of threw up on it, frankly, a couple months ago. But now, I think it's back, and I think the market now realizes that this is like we're at the bottom of the first inning for a lot of this, for this theme. As far as gold, I already touched on it earlier. It's been an unbelievable performer for us this year and last year. It still remains one of the best hedges out there, particularly if you're concerned about deficits like we are. And frankly, fixed income has really not been the hedge that we have always wanted it to be. It's been a fairly low returning asset class and frankly hasn't been that safe. And there have been periods of time where you've seen disruption in various fixed income markets that have, basically where they have gone down with the market. So in other words, it hasn't been a very good hedge after all. So, we have found what we do own in fixed income, we think are great hedges. But, it's really meant sticking to the front end of the curve and not trying to take any interest rate risk or credit risk. And then finally, we're really bullish on copper and uranium. So, the electrification theme really hits on both of these. Obviously, you need copper in power lines and transmission lines, and you need uranium for the nuclear reactors that need to get built, not just in this country, but everywhere. And what you have in miners in general is this incredible, huge secular future demand, just this massive tailwind. And yet it's really hard to increase supply. So what happens? Price goes up. So we want companies that are really levered to that. And so we've been adding those to the portfolio in addition to what we already had. Just to give you an example of how hard it is to create more capacity, the Trump administration is trying to fast track permits for BHP, a big miner, to build a new copper mine in the United States. This fast track process, BHP estimates they won't get any copper out of the ground for 10 years. Okay, so we have 10 years of runway where copper prices could, continue to increase because it's so hard to turn on additional supply. So these are the types of imbalances we'd love to populate the portfolio with. So what's next? Now, obviously, we're avoiding stocks with material exposure to tariffs. Give us the rules, and maybe we can find some interesting buys, some value plays. Maybe there is an interesting trucking stock to own, but we need to know the rules first, so that we can understand how their business models need to change. So we're avoiding that. And then we have to start thinking about the actual results of the Trump growth agenda. So remember, that's lower taxes and lower deregulation. That could mean a lot of things for a lot of companies. And so we're spending time thinking about how that could actually work out in certain companies' favor more than others. So our approach is basically we're very disciplined at this point. We're very disciplined about what kind of risk we're putting into the portfolio. I mean, clearly we've had a big run. We have to look a little harder to find overlooked value. Remember, a lot of what we do is a lot of fundamental work, and when sentiment goes against the fundamentals, that's usually creates the opportunity for us. So we're having to kind of broaden that out, which is also causing us to look a lot more internationally. We already have exposure to Japan, but there are some really great things that are happening in Japan. And so, don't be surprised if you see us expand our exposure there. And then we are selectively increasing our Bitcoin exposure, and largely because it creates another portfolio hedge. What we're adding, we think, are certainly things that would work great if Bitcoin goes up a lot, but they will also be uncorrelated to the rest of the portfolio, which I think is really critical in this kind of a market. And then lastly, because we've had this big rip in the last 6 weeks, we're trimming our winners. So let me take the next 4 slides. I'm going to go through our sort of flagship strategies, and then I'm going to follow it with something a little unique and different. So stick around for that. The Global Vigilance Tilt is our most aggressive strategy. It's right now 71% equities, but a bunch of the commodity exposures in commodity-linked stocks. So it has a lot of equity exposure. It's definitely for aggressive investors. although it's probably positioned on the more conservative end of where we normally have it. But it's been benefiting from some really great stock picking. Um, and we recently also added a new theme, crypto, to the portfolio and added strategy, MSTR, to get some Bitcoin exposure. But stepping back, I mean, we're really, really delighted with the performance this year. We're up over 11% year to date, which is not too shabby considering the market's flat. And so we were really happy about that. Our kind of most popular strategy with investors is our global vigilance moderate strategy, largely because most investors are moderate. And so this is the product that's been around the longest. It's been, we've been running this for over 10 years. Rick actually ran it for even longer than that. But here at our current firm, it's been over 10 years. And what we're really proud of is, while it's up 5.6% for the year, which is awesome, and is obviously crushing the S&P, the number we're most happy with is the since inception number of 8%. So over the last 10 years, we've annualized 8%. Yes, there's been years where we've, outperformed, and then there's been years where we've underperformed. But, if you're really thinking about investing your money or your client's money, you want it, and you want it to compound over time. This has been a terrific strategy for those clients and for that kind of wealth generation. This past month, we added some additional equity exposure. We actually rebought IREN, which is a Bitcoin miner that promises to potentially be able to lease out some of their space to AI companies. This is actually a good example of how we tax loss manage portfolios. Irene had been a loser for us, and we had lost some money on it before when we put it on previously. We exited. We were able to capture the tax loss. We waited a month. It actually went down lower, and we bought it actually lower than where we previously sold it. So that worked out great. We also added Freeport-McMoRan FCX, which is the copper play, and I just talked about why that's so important to us. And we were able to buy those funds by selling investment-grade corporate bonds. They just aren't that interesting to us right now. They have duration, which we're not really excited about. They have some credit risk to them, which we're not super excited about. So we kind of pulled the fixed income duration in even further, and we're able to deploy it into what I think are some really powerful themes. Our conservative portfolio has just been doing terrific. It's up 5% this year. It's been, again, it's been around for 10 years and delivered 6% annualized growth. So, this is just a good, solid portfolio for conservative investors. It kicks out about a 2 to 3% dividend yield, so you get a little income in there too. But if you really want income, we have our strategic income portfolio. Has more of a 5 to 6% yield. It's conservative. We basically cap the amount of equities in it to about 25 to 30%. And these are pretty, lower beta, higher dividend type names. But this one's done, terrific as well. Up 3% this year. Okay, so I've got two more slides, and I'd love to take your questions on anything. Most of these presentations, what I try to get across is why we're different. And I think if you listen to enough of these things, you'll understand why we're different. But, let's just lay it out there for you. And so I'm going to try to put in a couple slides at the end of, all of my future presentations on why we are different as managers. And the most obvious thing that's really popped up recently to us is we have a maximum or a limit of 30 positions for our portfolios. Now, why do we do that? And it's interesting too, because we evaluate a lot of other managers' strategies, and you see, we get these like 60-page brokerage statements with 210 names, and you're like, what is going on? And what you realize is that if you go back and you do the work, the academic work, is that 30 positions is the optimal number in a portfolio. It basically is enough to diversify most of the unsystematic risk out of portfolios. And beyond that, as this chart suggests, you get past 30 and your portfolio volatility doesn't go down anymore. It basically flattens out. So why have more? And if you really stop and, think about why the number of positions in a portfolio matters, let's just take a look at this. And this, and this is based on a lot of, other academic studies, but, Peter Lynch was famous for talking about this as well. But, the benefits of holding 30 positions is, number one, it captures the vast majority of diversification benefits. Number two, it's easier and more focused oversight and monitoring. So, when I walk in the morning, I got to worry about 30 names. It's actually more because we run more models and more portfolios, and there's not 100% overlap, but you get what I'm saying. I don't have, I can hone in on, okay, Kratos just announced a new contract. Okay, boom. What does that do to my model? That's the way we can start to think at, 7:30 in the morning. It allows us to also to do then deeper research. And that I think always leads to higher conviction, which is good. It probably means that you're more accurate and you get more things right. It also means we have more reasonable or lower transaction costs. And I don't just mean like commissions, because you don't pay commissions on most stocks, but I mean like the cost of terms of timing to trade vis-a-vis use that timing for research. Okay. And then lastly, it puts the portfolio on the efficient curve. So you think back to finance, portfolio management, classes. What this actually means in English is that that sets up the portfolio to achieve the highest expected return for the lowest possible risk. That is the ideal point on the efficient frontier. And that's what 30 positions better enables you to capture. Okay. I'm not going to guarantee it, but like that's better enables you to get there. Well, what about a portfolio that has 100 or 200 positions? And we see these all the time. Peter Lynch likes to call it diversification, which I think is a fun term. I wish I had invented it. Basically, it doesn't, as we mentioned on the previous page, the more positions does not decrease your risk any further. It doesn't decrease the portfolio risk. It actually, in fact, dilutes returns. So take, for example, let's say you have a stock like Palantir and it goes up 300%, but it's a 0.4% weighting. It's going to do virtually nothing to the overall outcome of the portfolio, right? You basically diluted it away by not, putting your money where your mouth was, or at least your research is. It also vastly increases the operational complexities and monitoring burden. Okay, imagine, do you think that somebody who's running a 200 stock portfolio actually knows what's going on with those stocks? They can't. They're overwhelmed by it. They can't possibly know. And then you got to like manage that. And like, how do you rebalance a portfolio that's 200 names without, just mechanically doing it? Like, there's no thought that's likely afforded. And so it also increases transactional and other frictional costs. I think that's obvious. Managing a behemoth portfolio is, just takes a lot more time. And it all adds up, evidence suggests, to mediocre performance. So I'm going to stop there, Keith. Let's see if anybody has any questions. I'd love to, answer them.
We do. And actually, I was going to ask this one about rate cuts. So, I was looking at a 30-year mortgage the other day. It's still almost 7%. So the specific question says, how many, if any, rate cuts are you expecting? He stops after this. He probably means this year's. And apologies if you covered it and he missed it.
Yeah, no. Great question. If you look at the Fed futures as an indicator of what the market expects, right now uh, there's about 50 to 75 basis points, like 2 or 3 cuts kind of priced in over the course of the next, call it 6, 9 months. Honestly, I don't have a great crystal ball on the direction of interest rates. What I would tell you is the number one thing I'm looking at is it's a combination of things. One is, do we actually end up getting inflation from tariffs? If we do, that's going to seriously complicate the situation. If we also then get economic weakness. So, my attitude, where we sit steady state today is I don't think any, interest rate cuts are needed. The economy looks solid, labor market looks solid. Inflation, I think, is basically, core inflation is essentially where it needs to be. The where we sit today, I think the reason why the market thinks there might be two or three is because we are still in a tightening mode, a restrictive monetary policy, and I think it probably would be, beneficial to, particularly for like the housing market and in auto sales, the interest rate sensitive products, plus whatever turmoil of the tariffs. I would like to see the Fed kind of cut 50 to 75 bips just to get back to neutral. Um, but it's all going to be data dependent from there. So, I wish I had a better crystal ball than that.
Yeah, yeah. Um, so a couple other questions we have. You talked a little bit about this near the end of the presentation. So he says, "Hey, I'm happy with the performance of the portfolios year to date. What kind of changes do you intend to make in the portfolios for the balance of the year?" You did touch on some of the things that we were looking at. Is there anything that might be on the bench, if you will?
Yeah, so I mentioned that we're looking really hard at expanding our exposure in Japan. Um, there's a really, they had three lost decades effectively, and now they actually have some actual real inflation, and that's allowing actually wages to be increased, and that's actually having a positive effect because it's not out of control, but it's having a positive effect of changing the Japanese consumer's mindset from, I could just wait because this is going to get cheaper, right? That was the deflationary mindset that they had for 3 decades to like, I better buy this now before it goes up in price. That's really more the mindset that, we're familiar with. And there's been a bunch of other very interesting structural changes, particularly also within the financial services world, but more broadly in terms of the way Japanese management teams are thinking about deploying excess capital and returning it to shareholders. So and the valuations are really cheap too. So there's a lot of really potentially positive things that are going that could generate a kind of positive flywheel effect in the economy. And so I think that's one place that we're looking to get more exposure. It also gives us some more diversification away from, kind of the volatility that we're experiencing in this market. I'd point that out. I'd say as far as our themes, we love our themes, and we're always looking for new opportunities within those themes. And then we're looking more broadly, I'd say, at um, adding to new themes or developing new themes. So, one place, for example, that we're really light on in the portfolios is financial services. And there's a lot of great value to be had in some of these names. And I'm not going to tell you ahead of time who they are, but suffice to say is that are areas of the market where there is real value that has been overlooked. And I think so long as we can get past this point of disturbance, is I guess the best word for it, with tariffs and all of this stuff, that and we look beyond to an economy that actually is going to be somewhat propelled by fiscal stimulus. That means some positive things for, particularly financial services firms. So that's just a couple of examples, but I mean, we've got a whole laundry list of things that we're constantly looking at. But that's just just to name a couple.
Right. So some of that may have answered this last question, which is so the go away in May didn't seem to be the case this year, and so what do you project the summer to hold for us?
Yeah, gosh, it's a great question. I've never been a believer in any of that stuff. The sell in May and go away. It doesn't always work. Um, one of the things that my mind first goes to is that everybody in New York City is calling this year a working summer. I don't know if you caught this, but like rents in the Hamptons are down like 30%. It's because nobody's going out there. Everybody's working. So I think if everybody's working, that means that there could be, a lot more, there could be some volatility to take advantage of. Obviously, I mean, my summers are always chock full of earnings and conferences, so I don't really get summers, but we'll get more data points in July with earnings. So, I think it's going to have probably, pardon the pun, but it's going to have its share of fireworks, whether it's the tariffs or or what have you. And we're just, we feel just really good about the names that we own and kind of feel like we can trim our winners. We can be patient to add to names. So yeah, I mean, bring what it may. But right now we're looking at, dips as opportunities. So, and we always basically look at it that way. But yeah, I mean, we will adjust. I mean, that's the beauty of being a tactical manager. We're not confined to any box. So, we will take advantage of whatever comes our way.
Awesome. Very good. Well, it looks like that's all the questions we have. Awesome presentation. If anybody needs anything, please feel free to reach out to us at any time, and we'll be sure to send the replay and the slide deck once it's been compliance approved. So with that, thank you for your time, and we'll see everybody next month.
Thanks.
Bye-bye.